Welcome to Spotlight. I'm Edgewenka, and we have a very important program for you this evening. We're going to be talking about pensions. You know that there's a section of the Labor Code that says the company or the employer shall provide some sort of retirement benefits, retirement fund for employees. So every company has to have some sort of retirement pension for employees. And we're going to talk about pensions tonight. And before I get into the conversation, introduce my guests, I want you to call your friends, those that don't have cable, those that have computers. They can watch us streaming live at jtvlive.net, because I think everybody wants to hear about this. I have with me this evening Mr. Clarence M. Faulkner. He's the Managing Director of Pension Management Interactive Incorporated, and he has 17 years experience in pension and investment management. He is a former investment manager of the Social Security Board. Good friend of mine. We served on the Health Service Authority Board together. Brother I consider my friend. Have a great deal of admiration and respect for. We're going to have a great discussion about pensions when we come back right after these words from our sponsors. Don't go away.
This program is sponsored by the law firm of J.S. Archibald & Co. and by the trust company J.S. Archibald Trust Services Limited, both of Roadtown, Tortola, BVI.
Welcome back to Spotlight. I want to welcome my guests from Pension Management Interactive, Managing Director Clarence M. Faulkner. Good to see you, my brother.
Good
Peace
evening.
and blessings. Yes, man. You left Social Security and start up your own business. You're going out there trying to collect past due invoices. You're no longer getting a paycheck.
Well, I mean, obviously, you know, there are some persons who have questioned the reasons why I've decided to move on. And, you know, I think the time was right for me to do something different, but also to contribute more to, you know, the economy and also try and protect persons from a different perspective. I think over the years, we've tried to make a real difference at Social Security, and I think now with, you know, the ambit of a lot of different things happening in our community, it's an opportunity for me to contribute from a different perspective.
Yeah, and you were handling quite a bit of money at Social Security. I would say to myself, this young brother, what is it, $300 million of our money you're managing?
Right now,
you weren't nervous?
You know, it's funny when I started, when I called my mother actually, and I said to her, you know, I'm going to take up the task of managing the Social Security fund. And she said, well, the only thing I could tell you is account for every penny. And, you know, the first trade I did some 14 years ago, it centered around a $1.1 million deal. And I can tell you after that deal, I went home and showered for an hour and a half, because the first thing that I was thinking is, how can I manage $1.1 million and be responsible for close to $100 million? And I think at that particular point, I started looking at the numbers as just a number. Because I realized I couldn't sit there questioning the decision process based on the size of the amount. I had to look at it and say, hey, it's a process. Yeah.
So you sort of like took the emotion out of it. You took the emotion.
You have to.
Just strict logic, reasoning, and sense.
Fundamental and technical analysis is what I say.
Yeah. That's cool. I was checking you out, man. I said, I didn't know all these things about you. You know, managing Social Security. Let me see, what else you did here? Currently, he serves as the vice chairman of the International Social Security Association Technical Commission on Investments based in Geneva, Switzerland. You know, was selected by heads of the CARICOM regional social security system to chair a committee to identify the most feasible methods of pooling resources for investment outside of the Caribbean region. You doing big things, brother.
Well,
For a young PV Islander, you know, you're making a Mac. You're somebody that we should be proud of.
I leave that to you.
Cool. Yeah. So it's great. It's great to have you on the program, and it's good what you're doing. Before we get into pensions, Pension Management Interactive, your new company, that is strictly managing pension or in other financial services.
We specifically focus on the area of pensions because typically pensions are simply associated with somebody doing something for retirement. We tend to take a more holistic approach in terms of managing an individual, and also managing an individual which specifically related to their retirement and pensions. Now, the whole area of pensions, we believe, focuses on the governance structure, which is the consultancy process, the management, which is the effective management of the plan and its assets, and then also the administration aspect, which speaks specifically to the reporting and the actual familiarization of the individual with what is happening with their pension commitments.
Okay. Right. Now, I basically know a pension is something you get when you retire. But there must be more to a pension than that. So for me, I know everybody else knows this answer to this, right? But what is a pension in its broadest and most specific sense?
To specifically differentiate between the two in its simplest form, a pension is something that you draw on for retirement, meaning that both the company that you're working for and yourself, which is sometimes optional, because normally you hear the term non-contributory and contributory, that relates to the employee. But a pension provides when the company and the individual puts aside something for retirement. Now, notice I say for retirement. The savings program now is something that you put aside, right? Which it refers to as discretionary income. And that discretionary income you can now access whenever you feel like, because obviously it's yours.
So you're not putting it aside only for retirement?
No.
Okay, so I have to find out about that, because all the time I'm thinking that once you talk about a pension, is you put something away, it's like Social Security.
For retirement.
You can't touch it again.
No.
You don't see it again till you're 65 or something.
Well, Social Security is an all-inclusive system whereby there are several other benefits that is attributed to the contribution that you make. The age benefit that is rewarded from Social Security is just one component of the entire package. Because remember, there are all the sickness benefit, maternity benefit, disability, and all the others. And that is part of the financing of Social Security in terms of the contribution at 8.5% that you contribute. Now, if you have your personal savings program, you obviously is putting aside discretionary income to draw on whenever you need it. If it stays and accumulate till retirement, that's a bonus. But if you're building a retirement program in the form of a pension plan, then you are putting that money aside and you cannot touch it. The other advantage of that is that government then have incentivized you to contribute to your pensions. Right?
How has government incentivized you to contribute to your pension?
Because under the Payroll Tax Act and under the Income Tax Act, there are provisions that awards a tax benefit or a tax relief should you contribute towards a retirement program or your pensions.
Okay, don't go too fast, because now I'm completely getting lost now. So, if I put away some money for my pension, when I file my income taxes,
well,
you don't file income tax, there's no income tax, it's payroll tax. What happens? Okay, that's right. I think I'm in America still. So, what happened? Does something happen to my payroll tax because I put away some money for my pension?
Well, the whole thing is what is referred to as pensionable earnings. And pensionable earning is that amount of money that you're contributing your pensions from, which is basically your salary. Now, let's say, for instance, you earn $100.
Right.
And you have determined that you would like to contribute X amount to your retirement, which is your pension plan. Let's say $10. The $10 should be netted from that gross amount of $100, and the payroll tax should be remitted based on the $90.
Oh, okay. So
that's the tax benefit. So you see, the system has now said, if you are going to provide for your retirement, then
we won't tax that money.
We won't tax that amount.
Yeah, okay.
The question then becomes, if someone now removes the money from the plan, should it be taxed? Because it has no longer been placed in a retirement program for the purpose of retirement.
So now you're using the money for something else.
Discretionary spending. Right?
So is there a regulation that stipulates or catch that particular action?
No. I mean, unfortunately, we have not received or seen the regulation that supports the section in the labor code. It is my understanding that that is now, in the works, and we're just waiting to see what happens there. So
conceivably then you could say that you're going to put out of the $100, you're going to put away $10 for the pension. You'll be taxed on $90,
but
then later on down the road, you take the $10 and you spend it.
No, that plan, in order for you to approve and for that deduction to be valid, Inland Revenue has to approve that plan.
Okay.
So once Inland Revenue approves that the plan has been approved by them, then you now can absorb the tax benefit because you've made the contribution under Section 70 of the Payroll Tax Act.
But I'm still at the question then. So who stops me from taking the money out after I made the commitment with Inland Revenue?
Who stops you?
Yeah.
Well, no one stops you. But if the money comes out of the plan,
yeah,
then once you do your filings and you declare what your income is, and you also have to submit a report of your overall pension plan, because remember, you've now been approved. Part of the requirement of the approval process is you submit a report on an annual basis to Inland Revenue on the status of the pension plan.
So everybody who have a pension now have to submit a report?
Once it's approved by Inland Revenue.
Yes. No, all pensions have to be approved by Inland Revenue?
For it to be recognized so you can get the tax benefit.
So you could get the tax benefit.
Yes.
So you could have a pension, as long as it's not recognized by Inland Revenue, you still going to pay the tax on $100.
Yeah, because you have no real grounds. Because when
so
you
that's how they catch you.
Yeah, when you submit your overall company financials at the end of the year, before April 30th, I think, they will do their reconciliation. Once they do their reconciliation and you said, our payroll for this year was X, right? Then you say in there that we did payroll deductions and contributions towards a pension plan. Okay, check the records.
The money got to be accounted for.
Yeah.
Yeah. Okay. So there are different kinds of pensions?
Yes. There are three standard ones. There's a defined contribution, there's a defined benefit, and there's a hybrid system, which is kind of a combination of both types of plans, DB and DC. DB mean defined benefit, DC defined contribution. Now, a defined contribution plan speaks to a fixed percentage of salaries being contributed to the plan during your time of employment. Right? So it can be a fixed percentage of your salary, or it can be a fixed amount. So the contribution amount is defined.
Okay.
Versus a defined benefit where a company pays you a fixed percentage, which is a fixed lump sum for life.
Oh, wait a second. Okay, one plan is that you put in a percentage of your money.
Yeah, and the company as well.
And the company matches that, or whatever the arrangement is.
Yes.
Whether it's 50-40 or whatever the arrangement is.
Yes.
Now another one, which is a defined benefit, it's an agreement between you and the company that when you retire, the company is going to pay you X amount for the rest of your life.
Yeah, it's normally calculated as a percentage of your last salary. So let's say, for instance, we say we're going to pay you 1/3, a maximum of 1/3 of your final salary for life.
So is that contributory? Do I have to contribute to that? So
No.
that's just
some systems the employees contribute. In most cases, the employer contributes.
And what was all over the last one?
A hybrid is somewhat of, elements of both a DC and a DB system that a company would say, we want the employee to contribute X amount, but we will promise them a minimum amount of X. And then there are certain other auxiliary things, like, say, for instance, if a company wants to reward an employee a bonus, they will say, well, instead of paying you 100% of your bonus, we will allocate X percentage to your plan, to your retirement. So, the employee doesn't take all the bonus money and
spend it.
Yeah.
Okay, we got to take a break.
Sure.
But we're going to come back and we're going to talk about where the money goes for the pension plan. Yeah. Keep it locked right here at Spotlight. We'll be right back with more on pensions right after this.
Spotlight is brought to you by CCT Global Communication, DataPro, Orion Law, Clarence Thomas Limited, Virgin Island Motors, and Bolo's Wholesale Cash and Carry.
Welcome back to Spotlight. I'm Edgewenka. I'm here with Mr. Clarence M. Faulkner, Managing Director of Pension Management Interactive Incorporated, and we're talking about pensions. And we're going to open up the phones soon, but we want to get some of this information about pensions out because I hadn't realized that there's so much stuff. You just hear about pensions and you figure it's a retirement fund and, you pay into it, and at the end of, your retirement, you start getting a regular check. But it seemed like there's a lot more than that. Now, we were talking about the various kinds of pensions. Yep. Before I get into what happens to the money management aspect, right? You were saying that there was some, in one is riskier than the other.
Well, it's not a matter of riskier than the other. With a defined contribution plan, once the contributions continue to accumulate, once that employee reaches the retirement age, then whatever the value is in the account, providing that what is referred to as a vesting schedules has been met, then that account now belongs to the employee. The employee at that point determine how they would want their retirement benefits to be paid from that lump sum. The catch is, once that lump sum is depleted, that pension is completed.
Okay.
And a defined benefit now, the onus is on the company who has promised that benefit for life to ensure that the proceeds are there to pay the individual or the employees of that company for their sustainable future.
So in that definable benefit, the employee doesn't have to worry as much about what's happening to the money that he's paying, because he's not paying in any money.
So in some cases they're not. Okay. And in some cases they are.
But if
he's not, then obviously that employee is simply sitting back and not worrying,
and waiting on his pension.
All the employee knows is, you promised to pay me a fixed benefit for life, and so be it.
And what happens if the company goes bankrupt before you retire?
Well, that's the specific area that we've been concentrating on over the last couple of years, and it's the issue of the governance structure. Normally when you see matters relating to pensions, persons are always concerned in terms of who has the responsibility, who has the authority to hold the assets, how should the assets be managed, are they managed in compliance with the demographics of the plan. And when we say demographics of the plan, are the assets managed from the perspective of the responsibilities and obligations of the employees, right? So what we've suggested is that companies establish a trust deed and a plan, and the plan rules.
No, you're not. I said talk in English.
Okay, a trust deed is a legal document binding a set of individuals to hold the assets of the pension in trust.
Okay.
Right? And what it basically does is it separates the assets from the company's operational assets. So therefore, if the companies go bankrupt in line with your question, then the assets in the trust and the plan cannot be touched.
Okay. So that's a,
right?
that's a security.
Exactly. So the company goes under,
But the money's still there.
the assets are there to meet the obligations of the employee base.
So is the company in that situation paying into a pension scheme that they have created themselves on a regular basis? Is that being monitored on a regular basis?
There's a word that you just mentioned that I cringe when I hear it, and it's the word scheme. We tend not to use the word simply because we don't want it to be viewed as a scheme. But obviously it's been in the industry for some time. If an employer is paying into a system, that's the process, the proceeds are paid in for the sole purpose to pay those benefits promised to the employees. That employee, based on how the governance documents are structured, the company cannot or should not use those proceeds for anything other than to pay benefits, right, or to honor the commitments. The company cannot tap into the plan and say we're using the money from the plan for operational things. No, that's strictly prohibited.
Can you borrow the money? Can the company borrow the money
No.
from the pension?
No.
Okay.
No.
Because I've heard of
There are some plans, however,
Yes.
that provides the employees with the option to borrow against their retirement.
the employees could borrow against the retirement.
Yeah.
But the company can't borrow from the pension plan
To use the proceeds for operational purposes.
Okay.
No, that is strictly frowned upon, and in some cases illegal.
Okay. Okay. Because when you say it's strictly frowned upon, it's a bad practice that can be done. That's what that means.
We've reviewed cases where it has been done.
Okay.
Yeah.
Okay. Now, so I think we kind of straight on the various types of pensions and the risk. Now, when an employee pays into a pension system, what's his responsibility and what's the employer's responsibility? What's the employee's responsibility? What's the employer's responsibility?
Transparency and accountability. The employers will identify a board of trustees in many cases, and that board of trustees will be responsible to ensure that the monies that are contributed to the plan are well accounted for, well invested, and that the employees who have contributed know exactly what has happened with the deductions that have come out of their salaries that have gone into this pension plan. So the issue of administration and reporting to the employee and the company is something that it is utmost priority to ensure that that employee knows exactly at any given point in time, this is where, you know, my pension assets and my pension commitments lie.
And that's the responsibility of the employer to make sure that that happens.
Well, once the employer has identified a board of trustees that are responsible for administering the trust, the onus is on the board of trustees, and they can assign any administrator to provide that information on their behalf. But the ultimate responsibility lies with the board of trustees of that trust.
And what is the employee's responsibility now?
Employees?
Yes. I mean, does the employee have a right?
If the employer makes the pension plan mandatory for the employees to contribute, then once the employees enroll, then the employees' deductions will come from payroll. So when the company runs payroll, they will do the deduction.
And you will see the money coming out of your pay.
Yes. So on your pay slip, you will see the money coming out, but then you'll also see the entry when you view your statement in terms of where the money went.
Well, what I'm asking is what are your rights under the pension system? Do you have a right to examine anything?
Absolutely. I mean,
what should you be doing? What should you be doing to make sure that your money that you have paid into this pension system is safe and secure and is there for your retirement? Should you just leave it up to the board of trustees? Should you just leave it up to the employer, or there's an onus on you to make sure certain things are happening with your pension?
Well, obviously, if anybody is putting money into something, I would encourage them to continue asking the question of, okay, whether it's monthly, quarterly, semi-annual, or on an annual basis, what is going on? And I mean, let's go back to the days of Social Security, where Social Security had this campaign that says, know what your contribution schedule is, know where your contribution status is. So call and check again, I think, was the campaign.
Yes.
No, the same thing with a pension. If you're contributing money into something that has been deducted from your disposable income in terms of your earnings, then I think, yeah, the onus is upon you to find out exactly what the Board of Trustees are. But the document, in terms of the governance documents that we talked about earlier, the trust deed and the plan rules, which are the governing documents and that explains the functionality of the plan.
Hold it.
Yep.
The plan rules are a group of rules that says how the
plan should be administered.
Okay.
Yes. And that includes the reporting structure for the employee base.
So the reporting structure is how you are going to know what's going on.
Yes, and how often you should know.
Yes. Okay. Now, when a company is deciding to establish a pension system and wants the employee to be a contributor, should the employee be looking at, for example, who's coming to set, what company you're going to set this pension system up with, how it's going to be managed, check out the management company. Are these some of the things that employees should be getting themselves involved with?
Employees,
yes.
No, I mean,
you come to my company, PMI come to my company, and encourages me to set up. Wants to set up a pension system for me, for my 100 employees, right? And I want a system that's contributory. I'm going to pay Pat, they're going to pay Pat. You want to manage the fund, the money. After I pay it in, you're going to keep it, make sure it's well invested, and the money is there when my employees come to be 65. Since they are paying into the system, shouldn't they want to check you out, make sure PMI is a reputable company, what your reputation is, how long you've been in business, how long have you doing it, have you ever swindled anybody out of their pension before? I mean, are those some of the things that employees should be paying attention to?
Well, here's the interesting thing. Normally, the employer will commence that process in the sense that the employer will say, and in some cases it can start from the employee base, because if a cumulative amount of employees want to get together and say to their employer, how come we don't have a pension plan? Why don't we have a pension plan? Then the employer may say, well, this is something that we're considering and we're evaluating. No, the onus is now on the company to now review the potential service providers out there who can propose a structure as it relates to what is effective for them. No, I can speak based on our process. I can't really speak for the other service providers. But with our process, we tend to come to the table with the understanding that let's not commence the discussion around investments, right? Let's commence the discussion on how can you establish a pension plan that benefits the company and the employee. So there must be a delicate balance between the two. You would have heard murmurs from companies who say, it's going to hit our bottom line because we have to contribute to this thing now because of the law. You've heard some employees say, well, our company is not doing anything for us and they'll just wait it out. The question is, how do you stand back as a company and now say, how can we increase the efficiency of our operation, the benefits as part of our compensation package to our employees that eventually reduce staff turnover, increase staff morale, and increase productivity, because now an employee knows, if I commit a certain level of service or a level of service to this company for a duration of time, there is a reward for me at the end, right? So that's the discussion we like to, that's the area we like to start. And then obviously you go through the whole governance structure. We don't believe that you come to the table and say, we have a fund that has regenerated 10% last year, invest in it and that's your pension plan. What is it based on? What type of actuarial analysis has been done that validates that that fund is the right fund for you? right? So what we tend to do is to say the discussion surrounding investments is a discussion that's a result of the demographics associated with the company and the employee base.
And what are these demographics?
The demographics means what is the employee age? What is the salary of the employee? When is this employee going to turn 65? What is the assumptions of the economy, the growth of salary? And those things will say to us, the amount paid to this individual, the amount likely to be paid to this individual in the future is going to be X amount. How do you now discount that X amount to today to say what is the contribution rate? Right?
But I'm still asking you, I'm still asking you as an employee, I'm paying a percentage of my salary, 10-15% of my salary.
That's right.
What percent I'm paying?
Yeah, go ahead.
Okay, I'm paying 5% of my salary for retirement. And shouldn't I immediately going into the pension plan, make sure that how this pension plan is going to be set up, how it's going to be managed, or how the benefits are going to be distributed? Shouldn't I know those things going in? And should I feel secure about all of those things going in?
One other thing that I forgot to mention is during the final stages of the consultancy process in designing this plan, one of the things that we say to our clients is before you adopt the plan, there's an educational session that we have with the staff, right? And that educational session speaks to the staff to say to the staff, your company is proposing such a plan, right? Because what you want is a situation where the employees have a say in the development of the plan. No, at the end of the day, the final decision rests with the company. An employee could come up with various avenues of things that they would like to see in the plan. Doesn't necessarily mean they'll get it. But what it affords us is an opportunity to go back to the company and say to the company, this is what your employees are really asking for. Do you want to consider it? If the company says yes, we draft the terminology that affords them the opportunity to provide such a benefit. Because the last thing you want is to have an employee base that will simply think, this company has created this plan, it has pushed it down our throats, we don't have a say. We just have to go along with it. Versus the employees having a say and having an input in the developmental process. It affords them an opportunity from an educational point of view to become more knowledgeable about the subject matter. So once the plan is launched now on its effective date, the company has the buy-in of the employees as well.
We got to take a break.
Yeah.
And we're going to come back, we're going to talk some more about pensions. I still have to answer the question about what happens to the money and what pitfalls we need to look for, if any, while we get involved as employees and employers in these pension plans.
Yeah.
Keep it locked right here to Spotlight. We'll be right back.
This program is sponsored by the law firm of J.S. Archibald & Co. and by the trust company J.S. Archibald Trust Services Limited, both of Roadtown, Tortola, BVI.
Welcome back to Spotlight. I'm having a learning experience here with Brother Faulkner, the Managing Director of PMI, Pension, what's the name of that company again?
Management Interactive.
Pension Management Interactive, and we're talking all kinds of things about pensions I had no knowledge of. So I'm at the foot of the teacher. I'm having a good time. It's always good to be learning new things. You could call us, if you want to ask some questions that I may have forgotten to ask or don't know to ask. You could call us. The phone number is going to come up on the screen, or you can text me, and we'll be happy to ask Mr. Faulkner your questions about pensions and some of the things that you need to know. Now, I want to get into, because I know there's a burning question in most people's mind about what happens to the money. Does it sit in a bank, gaining a 0.5% interest, or is it invested in some stocks in the United States or Europe, where you could lose all the money with a crash or something? So people, that's a burning question. But just before, and I keep putting it out, but just before that, are there pitfalls that we need to be aware of when we are entering pension systems, whether as employers and or employees?
Well, I mean, in anything you do, there is some level of pitfalls that I think everyone will try to avoid. Obviously, the analysis of the service provider is something that you alluded to earlier, in terms of, does the service provider bring the level of expertise to the table that gives you that level of comfort in terms of outlining their process of how they are managing pensions? No. There's several pitfalls that you can think about, where you have some companies who would say, we manage pensions, but they can't explain to you the real ramifications behind pensions. So you ask the questions, is it a matter of what is referred to as hoarding capital, where they simply collecting proceeds and then managing it? There's also the issue of conflict of interests. Is someone making a recommendation, doing the management, signing off on the accounts, moving the money around? So, there are several little things that
Say that again?
Conflict of interest.
Yeah, whether...
It's where the decision maker, the investor, the recommender, and then the signing authority is all held by one person and one firm. So now you ask yourself the question, okay, this person has made a recommendation for me to invest in such, but then they've also had the authority to go ahead and do the investment as well, right? Hence the reason why I go back to the governance structure. When you have a situation where a company will simply say, we have given all discretionary power to this company to manage the pension plan, you have to ask yourself, on what terms and conditions has that discretionary power been given?
Okay, hold a second.
Yeah.
You come to me as a service provider, and you tell me to open up a pension plan. We open up a pension plan, and you're managing the money. That's
not in our case, but yes, there are some. Yes.
I'm trying to get an example of what you're just talking about, so I can understand it.
Yes.
Right.
Yes. Like someone come to you and says to you, "We'd like you to, set up a plan. We'd like to do a plan for you. Or we'd like you to join our plan." Then you either sign on with them and you give them the proceeds, and they have the discretionary authority to say, okay, this is how we're going to invest the proceeds.
Okay, so you managing the plan,
you managing, administering, everything. Yep.
And I'm the employer now. I don't really know what you're doing, and I have no reporting mechanism to check you.
You should have, yes. But I understand what you're saying. If you don't know what's going on, that in itself is a problem, because at the end of the day, you are ultimately responsible.
Right.
There's a school of thought that says you cannot outsource your fiduciary responsibility. That responsibility lies with you, right? So if the labor code, let's say for instance, in this case says the employer shall provide, then by simply saying, I have contributed this money to this account, I have given it to John Doe to manage, I am done.
Okay, so when the time comes for retirement now, and I don't have the money to pay the people in retirement what they gave me, I'm going to get in the jail.
I don't know. Somebody has to be held accountable.
And then I have to sue you because I gave you the management of the account.
Well, I mean,
that's the kind of mess that it becomes.
Well, you want to ensure that that mess doesn't occur.
That's one of the pitfalls. That's the pitfall that we have.
You want to make, and that's the very reason why we have focused on developing pensions from the perspective of a governance structure. Who are the trustees? What are their responsibilities? How can they be terminated? What are their rules and conditions of appointment? right? That's one. The plan rules, which is the functioning document of the pension plan itself that says to the company and the employers, this is how the plan should be managed. What is the definition of all the different categories that may come across? Child, beneficiary. What happens if you're disabled? What happens if you want to retire early? What happens if you want to work beyond 65 or 60, whatever the retirement age is? You need to know that even before you start, right? Added to that, to speak to the topic of investments, is the investment policy statement that says these are the guidelines by which the investment assets will be managed. Now, if a firm shows up and you simply say, here is the contributions from my employees, go ahead and manage it. And what are you managing it by? What are the restrictions that you have given that person that they should not invest? Right? How do you mitigate the probability of loss based on the decisions you make to invest?
So the employee should be checking for these things.
Well, it's not necessarily the employee. The trustees and the company establishing that plan needs to ensure that those are in place.
But you're asking me to trust the trustees.
Well,
I mean, shouldn't I have a certain level of?
But if you're making contributions into the plan,
that's what.
Then you ask the question.
Yeah, you have to know to ask these things, and these are some of the things that you need to be asking. So you need to be aware of the rules governing the pension plan.
Yeah, and the way matter
of fact, give me a list of things I need to. I need a list of things I need to be aware of.
And for us, as part of the last phase, remember I talked about the orientation or the educational phase with the employees. Once we're completed that phase, one of the things that we do is we develop what is referred to as an employee handbook.
Okay.
That provides questions and answers of general terms that will come across in the main documents. So the employee has this book as kind of their quote-unquote pension Bible that says, this is how my plan works. It alleviates the traffic to HR, because employees are going to call someone because they want to have answers. Okay. But by going through that educational session, by giving the employee the handbook that explains the plan and other terminology, that employee is now equipped to say, I know what's going on with my plan.
Okay.
Yeah?
Okay, cool. Now, what happens to the money? I pay the money into the pension. Well, no, the employer deducts the money from my salary.
And pays it into the pension plan.
And pays it into the pension plan.
Yep.
Who gets the money? Where does it go? What happens to it?
Okay. Now, the money is now invested on what terms? It's based on the terms of the investment policy statement.
Okay.
The investment policy statement will basically articulate what are the kind of investments you can invest in? What are the options for investments that you can give to your employees and the company? What is the risk profile of those type of investments? What are the type of investments that you're totally restricted from? So once that is in place now, there's service providers out there, which would be investment management firm, that specializes in the category of investment that you would want to invest in, or that the trustees have awarded in the investment policy statement that you should invest in. Then once those service providers are contracted by the board of the trustees, that's where the money goes to. Okay.
Now, does the money have to be invested, or you could just sit and wait somewhere?
Again, right back to the investment policy statement.
It depends on
if the trustees say, you know what, we've analyzed the market, right, in conjunction with our consultant, which is normally PMI. We've analyzed the market, and we don't think it's a good time for us to be investing in the market. Can we hold the money in cash or in an account? The downside to that is, with the increased cost of living and inflationary pressures, the money is not growing. Right? So that's the
downside. Just having money sitting there, you're losing money.
Absolutely.
So the money has to work.
Yeah.
Okay. And so you're, as a manager of the fund, it's your responsibility to make sure that it grows. So at the end, you get more. Well,
no, in the end, you want the contributions that you've remitted to the plan continues to grow.
I have to ask you another question then. If you paying in a certain 5% every month into the system, into the plan, are you going? How is it determined how much you're going to get back?
Well, remember, with a defined contribution plan, right? Whatever you've contributed to the plan and whatever it has accumulated to, inclusive of interest and investment return, that account now is yours, right?
Okay.
Now, the key thing to also mention here is that with a defined contribution plan, the employee bears the risk of the loss of investment. Because if now I have said to you, all right, we're going to give you these two options, large cap growth equity and bonds. You decide which option you want to choose. Then if you chose equity 2 years before you're ready to retire and the market sinks and the value of your account is down, then that's the value of your account when you're ready to retire.
Okay.
Right? Versus with a defined benefit system now, you don't care what the market, how the market fluctuates, simply because the company has promised you a payment, a fixed amount for life. Right?
So when you invest in, you have to be when somebody
there's a huge educational element in there.
In there, you have
right.
to know how the fund is being invested and all of that.
I am very guarded when I hear persons or service providers come to the table and say, invest in our plan, we guarantee you a 5% return. You have to ask yourself, how is that 5% derived? What is it invested in? Right? And if it's invested in an international market, unless it's a fixed bond that is paying a fixed amount for a set period of time, then I would begin to question the makeup of how that 5% is derived.
Because then there are risk factors involved that you
any type of investment bears some level of risk. The question is when you are determining the investment policy statement, did you derive the risk associated with your employee base? And if that employee base says all risk is moderate, then you design an investment structure that is moderate.
Okay. Well, so that we don't scare anybody. The normal thing, though, is that you invest, you pay into a pension plan. It's structured in a way that is prudent, and it grows and grows and grows. And at the end, at the time of your retirement, you will be getting back a considerable amount more than you put in. That's the goal.
That's the goal, but I don't necessarily like the word considerable amount, because during the time of your working life, obviously the market fluctuates. Okay. So, you know, that has to be taken into play as well. So it can be, I'm not saying not, but remember, a certain amount of return comes with a certain amount of risk. So it depends on what the employee's risk profile is. So they can say, okay, for this amount of risk, I can't expect the big double-digit returns because I'm not taking that risk.
You're taking the big risk.
Exactly.
Okay.
Right.
We're gonna take a break and we're gonna come back, and don't forget, you have an opportunity to, got a wealth of knowledge here. You have an opportunity to get as much information out of Mr. Faulkner as you possibly can, so that when your turn comes to get involved in a pension plan, you know the right questions to ask, you know how to put the spotlight on the plan, so that your money is considerably safer than it normally would have been. Some people say that the pensions are expensive for the company, and it might be expensive for the employees. There are ways that people can group pensions together, so that say several companies could group together their employees, so that you have a lower cost for the pension. I don't know how that would work, but that's a question about grouping pensions. I don't know if there's such a thing. But before you answer that, let's take a break. And from this word from our sponsor, we come back. We got some text we got to read, but we'll come right back after these words, and we'll answer that question about group pension. Is there such a thing? And we're gonna get to your texts and hopefully some of your phone calls. Don't forget to call us.
Spotlight is brought to you by the National Bank of the Virgin Islands, Tortola Concrete Limited, Orion Law, Clarence Thomas Limited, Virgin Island Motors, and Bolo's Wholesale Cash and Carry.
Welcome back to Spotlight. I'm here with Brother Faulkner from PMI, and we're talking about pensions. Let me see. I was supposed to ask you a question when I come back, and I forgot what it was.
The issue of group.
The issue of group. The issue of group. Yes. What is there such a thing as having a group pension, and like more than one company coming together and pooling their resources, and that, does that make a savings, or what's the benefits, the advantages of that?
Yeah, I think you're specifically referring to how can you maximize the economies of scale by, say, for instance, pooling a group of people or companies. You may have heard of a launch that we did about a month ago for the BVI Chamber of Commerce and Hotel Association. Yes. And the mandate we reviewed when we when we were lucky to assist them in developing that plan. They wanted to look at their membership base and determine how can we establish a plan that all our member companies can contribute to in a cost-effective way. And what we did is we customized a multi-employer pension plan for the chamber members to participate in. Now, the way that works is that it's a master set of documents in terms of the governance structure, trust deed plan rules, investment policy, employee handbook. But because it's several individual companies, there is something referred to as a deed of adherence that say the companies now can then agree to adhere to the rules of the plan by signing a deed of adherence.
Okay, hold on a second. Thank you for calling Spotlight. Go right ahead, please. Go right ahead, you're on Spotlight. Speak. Caller, you there? Okay. Apparently, I lost that caller.
Okay.
Okay. Yes. So
the deed of adherence says that as a company, I will agree to adhere to the terms and conditions of the master plan of the chamber. And what that has done now, it has alleviated the companies having to establish a board of trustees, have to do administrators, and so on.
So you have one big governing body?
Yes.
Okay. Thank you for calling Spotlight. Go right ahead, please. Go right ahead, please.
Yeah.
Yes.
What I
Say it again. Say it again, caller. Okay, I don't know what happened there. Okay. Caller, you still there? All right. Okay. Try calling again, please. So you have one governing body.
Yes.
And you have all these companies.
It's from the board of directors of the Chamber of Commerce. They have now established a board of trustees who's responsible for managing this plan, where all the companies can join into. Now, the investments are now performed based on an investment policy from the chamber plan, right? And then the reporting structure says that all individual employees are reported to, all companies are reported to, and then the chamber itself is reported on the status of the plan where all their companies have contributed to.
So anyone could now join the BVI CCHA's plan?
Well, it's
any company could join their plan?
Yeah, once I think they have to be a member. I would encourage them to become a member of the Chamber of Commerce and Hotel Association.
If you want to be a part of that plan, you could become a member and become a part of that plan. What is the advantage to being a part of that plan as opposed to opening up your own plan?
Well, for us, because we customize plan, obviously the companies have the advantage to then tailor make the plan specifically for themselves. And obviously they have the ultimate responsibility and holding of the trust. With a pension, with part of the chamber plan, you fall under the rules and conditions of that board of trustees. So you just basically agree to adhere.
So you just have to make sure that what you're adhering to suits your needs.
Yeah, but the way we've done the deed of adherence is we've said, okay, even though you're joining the chamber plan, you now have the discretion to establish your own contribution rate, your own vesting schedule, and what amount of employees you're going to cover as it relates to coverage.
Okay. Yeah. Thank you for calling Spotlight. Go right ahead, please. I don't know what's happening. You're on Spotlight. Can you hear me? Can't hear me. Okay, I don't know what's going on with the phones. You could try to text and see if you have any better luck. So is that something that you are encouraging, or if other companies can get together, particularly smaller companies? Is that a good way?
That's an excellent avenue for smaller companies to access a program, simply because you utilize the economies of scale. It's cost effective, and there is a governing body that will handle all the affairs.
So you're getting your interests protected, look out for in a certain way, and you don't have to pay the big bucks if you are by yourself.
Yep.
Okay, that sounds like a plan. Let me see. Is there anything there? Let's see what we have on the. Okay, very good presentation to my Virgin Gorda brother. You have really shed light on retirement. Congrats. Okay, that's a good positive comment. That's a good positive comment. Let's see. What recourse does an employee have when money is deducted from salaries and the money is not paid into the fund on time or not at all?
What recourse does the employee have?
What recourse does an employee have, right? When it, I think we asked that, but when you pay your money in, and when the money is deducted from your salaries, because normally it just automatically comes out, right? When it comes out of your salary, but the employer doesn't pay it into the fund, what recourse do you have when you find that out?
Well, because you should be always aware of what's the status of your account. Then I think you should go back to the employer and try to identify why the money has not been contributed. I know from. Go ahead.
No, you go.
I know from our end, what we try to do as the administrator of the plan is to constantly update or contact the employer to say, okay, payroll was the 25th of this month. The contribution should have been made to the account either the day after.
Where is it?
Within. Because you see what happens, you run the risk of the employees not being able to gain access and investments return because the monies have not been put into the plan. And that's not something that you want to encourage.
An opportunity might be there to increase the investment, and if the money is not there, you can't use it to invest.
Absolutely.
Okay. Now, you get regular statements about your pension plan status, this is individual. This is an individual account. Every pensioner has an individual account concerning his specific pension, about part of the pension.
There are two sides to it.
Okay.
One, the statement should capture all the details surrounding the employee in terms of the employee demographics we talked about earlier. And it speaks to even who the beneficiaries are for the individual should something happen to the individual. But it articulates exactly what the contributions made from the employee and the company, and then we also have a provision referred to as voluntary contributions, right? But then on the other side of that statement, you should also capture how have the money been invested, what is the return on those investments, so the employee knows this amount of money has been contributed from me, from the company, right? This is the total. That total is now invested. Right. This is how it is invested, and this is how it has performed, and this is what it is invested in.
Okay, so it's invested over here.
Yeah.
It's getting 5% interest per year, and so far it has increased by 20%.
By way of example, yes.
By way of example, yeah. just so I have to understand it, right? And sometimes my head ain't so good, so I have to make sure I make a simple example. Yeah. So,
but in terms to further the discussion around recourse, I think that's one of the areas we're waiting to see what the regulation says, because there should be something that encourages, or I should say discourage employers from holding on to the contributions after the deduction has been made. right?
Right.
So,
so if you see a situation on your report where you put some money was deducted on the 15th and it wasn't deposited until the 30th,
yep,
then there's cause for you to be concerned.
Yeah. But I mean, one of the things that we do as a company is we touch base with all our clients. Should we realize that, okay, did we get the contribution for that month? Right? Because one of the things we want to do is to populate our database to ensure that we capture all the information. But because with our clients, they normally not only get just the statement saying what they're entitled to, they have the access via online to say, okay, can I view my account and see what is happening in my account? So if we don't get the information in a timely manner to populate the data, then the employee would be questioning, I mean, why wasn't the money, why was the contribution made to my account?
How come you don't see it there?
Yeah.
But the question still remain, if a situation like that developed where the money has not been put into the account,
speak to your company.
But I mean, what if something has happened to the money? What can you do about it?
When you say something has happened to the money,
you can't get any proper accounting of the money over a period of say 2 or 3 deductions. The money is not there, and you can't get a satisfactory answer from neither the manager of the fund or the employer.
And that's where the regulation has to support that process.
So we don't have regulation yet.
That's what I understand. It's in the draft stage right now, and I think it's before the Attorney General's chambers.
Okay, so that's coming. But so then, right now, the employees of one.
The onus is on the employer to ensure that those contributions are remitted.
Yes, but then the employee can't do anything about it if it's not, because there's no regulation in place. I mean, for me to take him to court, to have him locked up,
there's a section in the labor code that talks about good corporate citizens in terms of making sure that employers, exercise good judgment as it relates to, dealing with their employees, and whether or not that topic can be utilized or broadened to some extent, then provides that some level of recourse.
Okay, this is our final break of the program, so be sure to get your cards. And I don't know why we're having difficulty with the phone, but try calling again, and of course you could text us. So try to get your questions in. If you haven't been successful on the phone, send me a text. It seems like a text is working fine. I'm going to read some of the text questions when we come back right after these words from our sponsors.
This program is sponsored by the law firm of J.S. Archibald & Co. and by the trust company J.S. Archibald Trust Services Limited, both of Roadtown, Tortola, BVI.
Welcome back to Spotlight. We have a few minutes remaining. You can text or call us with your questions, and then hopefully we've been able to bring you enough information so you know what questions to ask the service providers, the people that set up the pensions and do the management and set up the structure and so on. So if you still have any questions, the numbers are on the screen. How much you will have to give from your salary?
Well, that depends on how, because the labor code does not provide a specific starting point. Some of our clients have asked us, what is the minimum contribution rate? And if you remember the example I used earlier in terms of understanding the demographics, what we have done is we've used the labor code as a starting point to say, in the absence of a plan, what are you liable to pay should that employee reach 65 and retire from you? So once you've identified what that amount is, using an actuarial formula, we've discounted that figure back to today to determine what that contribution rate is. So from a company perspective, you now know, if I don't have a plan, and still have the obligations from the labor code in the absence of a plan, at least you know what that figure is. What we've done is we've used that figure as a starting point to say to a company, worst case scenario, this is what you ought to put aside.
So you need to provide, you need to have this somewhere.
Yeah.
In the event of this person retiring.
Yes.
Yes.
Right? So you now know that amount. So the catch now then becomes, do I run the risk of not putting a plan in place and then having to pay that lump sum figure out of operations versus establishing a plan and incrementally contributing to that term?
Which is more affordable.
Yes. Because you're now building up to that amount versus having to pay out that one amount at one specific point.
So can I decide at the end of my at my retirement whether I want to take all of my money out of the pension plan in a lump sum, or I want to have it paid incrementally?
You should be given the options. Obviously,
is that an option to be established at the beginning of the pension?
Yes, in terms of the plan rules. So you're establishing the plan rules, and you say, okay, once you retire, you have several options. You decide, all right, I'm going to take a lump sum.
I can take a lump sum. Yeah. I can take an incremental payment.
I can defer my pension. I can decide I want my lump sum to be paid out in 60 payments, which is over a period of five years. You'll probably just get a 5-year annuity program. You can get a 10-year annuity program or a 20-year annuity program. So yeah, you have the options.
And the things to consider is what you want to do with the money, whether you want to invest it in something else, whether you want to start a business in your retirement, or you can have any number of options, and you can use this money for it.
Hopefully you don't use the money for that. Hopefully that money is to take care of you
until
now that you're, well, yeah, because I mean that's the real purpose of retirement. I mean, the issue of pensions, we don't look at pension in isolation from the entire picture, because we see it as a part of the equation. Retirement encompasses 3 different pillars: discretionary savings, Social Security, and pensions. Now, discretionary savings is centered around the person's ability to put aside discretionary earnings during that time when they're working, right? Now, persons between the ages of 18 to 45 don't like anyone telling them how to save and what to do with their money. So that's on the individual. Social Security is a government-sponsored system that mandates persons contribute to the system, but that's not only about the age benefit. There are other benefits as well. And then pension now is more from the employer side, that says we will contribute and award an employee for the services rendered to the company while they're with us. So a combination of those 3 facets now affords the employee the opportunity to maintain that standard of living once they stop working, so they can continue on.
Okay.
Yeah.
In that case, who's receiving the interest from the pension?
The employee.
The employee receiving it.
Yeah.
Okay. Is this the first pension in the BVI? The first time the BVI is involved in pension schemes?
No. When you say, I'm not certain I understand the question. Let's say, for instance, you go back to
Social Security is a pension scheme, but
no, Social Security is not a pension scheme.
It's not a pension scheme.
Right. Okay. Social Security offers an age benefit as one of its
many benefits.
Yeah. Social Security is a protection system that basically replenishes a portion of your wages due to your incapacity not to work.
So this kind of pension, is this the first of its that the BVI is getting involved in?
The one that we did for the Chamber of Commerce is the first of its kind, yes. Okay. Right, but there, I mean,
but we've never had a mandatory pensions before. No.
No, you mean based on with the implementation of the labor code?
Yes.
No, there hasn't been a mandatory. There are several companies who have already had pension plans.
Okay. Who is responsible for pension when employee give employer permission to withdraw payments for tax and security, and it's not paid?
Board of Trustees.
The Board of Trustees.
The company must remit it to the Board of Trustees. There are some companies who send it straight to the investment providers, and they have no governance structure. So then it's between the company and the service provider. So the question then becomes, If the company goes under, like you were talking about earlier with the bankruptcy, then what do you do? Who do you turn to? Who's protecting the assets? Yeah.
And there's a board of trustees.
It should be the board of trustees.
What if I contribute for 2 years and leaves the territory? What will become of my pension?
That heavily depends on the vesting schedule. Because if an employee says, and if an employee is contributing to a plan, then whatever they've contributed, they're entitled to receive it back, plus interest or investment returns. Now, if the plan has what is referred to as a portability clause, that portability clause affords the person the option to transfer that plan over to a different company's pension plan, whether it's another company in the BVI or another company outside the territory. So if the plan is structured that has the portability feature, then that employee has the flexibility to say, I'd like to take my pension where I am going.
Okay. And you do individual plans?
That's something that we're working on, simply because with individual plans are such that employees or individual want to contribute what they feel like. And once an individual is doing that, they cross the line between the whole issue of anti-money laundering legislation, because you need to now derive where that employee is getting these lump sum contributions from.
Okay.
Right?
If somebody want to get in touch with you, how can they do that?
Pension Management Interactive, 494-4484 or 85. Email address info@pmipensions.com. And we're on the second floor, Mill Mall, closest to the Palm Grove Park.
All right. Thank you, my brother. Good information. I think I've achieved my goal of bringing information about pensions to the public. So I'm happy about that. Let me see. There's a number of things coming up. We have next week, the spotlight is going to be on Dr. Louis Fallick, who is who's going to be in the country to do a workshop on a learning potential assessment device. A learning potential assessment device. Now, this is a procedure and a set of instruments enabling one to evaluate the learning process and identify an individual's cognitive functions, operations, and problem-solving strategies. He's going to do a workshop on how we can assess this. I think this is really important, right? And this LPAD is Learning Potential Assessment Device. It's based on Mr. Feuerstein theory of structural cognitive modifiability, which proposes that intelligence is dynamic and modifiable, not static or fixed. Right? Everybody could learn.
Yeah.
Right? And this workshop is going to have a tremendous impact on our education in the territory, so make sure you're here. Don't miss it. Spotlight is going to be, of course, on Channel 55, Tuesdays live at 8 p.m. and rebroadcast now every Sunday, not 4:30, but 2:30 every Sunday afternoon. You can see Spotlight on Channel 55, and of course, you could go to jtvlive.net and find all the spotlights there that you've missed in the past and the current one. So you can check us out on jtvlive.net anytime you want. Coming up, we're having a game show that's going to be on the radio on ZBVI next week. It's going to be it's called VI Culture Grill, and we're looking for contestants. We're looking for high school, young people from high school, 4th and 5th forms and early college, no older than 23 years old. And it's sort of like edutainment. It's going to be culture-based, so we're going to be asking questions about the history of the BVI, the culture of the BVI, economy of the BVI, the politics of the BVI, all things BVI, so that our culture and information about our territory could be, produced en masse to the viewing or to the listening public, so that we all could start learning about the BVI through edutainment. So it's going to be a fantastic. I'm not excited about it. I'm looking forward to it. It's going to be exciting. It's a fantastic program. If you're a youngster in 4th or 5th form, and even 3rd form, depends on your age. Even 3rd form, 3rd, 4th, 5th form, and early college, no older than 23, and you want to be a contestant on VI Culture Grill, you can email me at crom53, that's CROM53 @hotmail.com. I'll send you the rules, the regulations, and what happens is I send you the questions and the answers so you can study and be prepared for the program. Now, it sounds like it's a giveaway, but it's not, because you're going to be asked about 5 or 6 questions a night out of 90 questions in 3 categories that I'm going to supply. So it's not going to be as easy as you think. And we have some great prizes. Everybody's going to get a $25 tap-up from CCT. The first quarterfinalist is going to get a cell phone. The quarterfinalist winner is going to get a cell phone. The semifinalist winner is going to get a Kindle Fire, and the champion is going to get iPad. Now, the champion is since you're going to get all those prizes along the way, the champion will get, of course, a tap-up, a cell phone, a Kindle, and an iPad. So it's going to be some great prizes, and then we're going to take it. That's going to be for a few weeks on radio, and then we're going to take it to television. So look out for cultural quiz show coming up in starting next week on radio and going over into television. Send in your requests for the package that's going to tell you the rules, give you the application form, give you the questions, and what the prize is going to be. Email me at crom53 @hotmail.com and get in on this prize bonanza while you learn about your history and your culture, and we show the rest of the territory and the world our culture and our history. It's educational. It's going to be a lot of fun, and we're going to learn a lot from it. Yes, so I want to thank you all for watching. Thanks for your words of encouragement, your suggestions, your criticisms. You can continue to email me for Spotlight stuff on jtvspotlight@yahoo.com. Mohamed Juenka reminding you that when the spotlight is on, you see the facts. Peace and blessings.
Spotlight is brought to you by CCT Global Communication, DataPro, Orion Law, Clarence Thomas Limited, Virgin Island Motors, and Bolo's Wholesale Cash and Carry.